Good day, class. Once again, you are welcome to study section 10. And in study section 10, we want to look at investment appraisal in the public sector. Before now, you must have taken a course or a topic on investment appraisal in the management accounting class or performance management class. We have introduced you under that course to capital budgeting, which is another word for investment appraisal, capital budgeting under certainty, and capital budgeting under uncertainty. So what we are doing now should not be completely strange to you. What's our learning outcome for this study 10? Number one, you should be able to explain the investment decisions in the public sector. How are investment decisions taken? Then two, you should be able to illustrate or explain and illustrate the various methods of investment appraisal in the public sector. When we talk about investment appraisal, what exactly do we mean? Investment appraisal is a decision to allocate scarce resources on various viable opportunities with the view of earning reasonable returns for the benefit of the resource providers. Again, that should be very clear. Part of the money that accrues to the government, either at the federal, at the state, or at the local government level, can be invested. And when such surplus funds are to be invested, due process must be followed. We must consider different alternatives, sources of investment, aside from evaluating the cost of such investment or such project. We also want to find out what will be the likely benefit that will accrue if we invest in such projects. And there are competing projects. So out of the many competing projects, which one do we want to pick? Which one do we want to implement? There are many ways by which we can evaluate the investment proposals before us for the purpose of picking the one that will be the more viable. Well, in government, investment decisions are based on viability of projects after proper evaluation. There are two sets of decisions that are to be made, namely, one, what we call program decision, and two, on program decision. What do we mean by program decision? Programmed decision. It is a routine strategic decision. It is made on daily basis and is a solution to routine problems. That is for programmed decision making. The solution will be under programmed decision making will be determined by rules, procedures, and habits. The decision is mainly for uncomplicated issues. Then number two, we have what we call unprogrammed decisions. Unprogrammed decision. Unprogrammed decision is a non-routine strategic decision. It deals with major decisions, unusual and once in a while action, e.g. decision that has to do with changing the focus of an organization. So those are generally the two major decisions that are taken in the government, the public sector. Projects are usually undertaken in the public sector via the Ministry of Works. The process is achieved through the means of what we call a competitive tender or a negotiated contract. What do we mean by the two? Under competitive tender, the contractors are to tender for the work to be carried out. They are invited by open tender to the general public, and by the time they submit their quotations, these are negotiated through the tender board process. Such contractors are invited for negotiation and discussion, after which appropriate decisions will be taken. Then under negotiated contracts, the Permanent Secretary, Federal Ministry of Works, calls upon any of the registered contractors whom he believes can undertake the contract to come and perform the job. So that is by way of procedure. Now, given that we could have alternative investment projects, how then do we appraise the project? How do we evaluate the project? What methods do we use in evaluating or in appraising projects in the public sector. We have a number of them. There are some you are very familiar with them. It's just by way of application. And maybe there's one or two which you may not be too familiar with, which we just introduce you to. And of course, you'll be familiar with all of them because you are taking public finance as a course. And under that, we have considered, we have it as a major topic, cost benefit analysis. So the different methods of investment appraisal in the public sector are outlined as follows. 1. Cost benefit analysis. 2. Cost effectiveness. 3. Accounting rate of returns. 4. Payback period. 5. Net present value method. And 6. Internal rate of return. We'll now take them one after the other and see what is involved. When we talk about cost benefit analysis, just like the name implies, it is a system that enables the comparison to be made between the estimated costs, both financial and social, of undertaking a project and the benefit that will accrue or that will arise from the operation of such a project. We have project A, B, and C before us. The question is, for project A, how much should we need by way of investment, and what will be the returns on that investment on that project? Ditto for B, ditto for C. After that, we now compare and pick the one that will give us the highest returns. There are a number of steps involved in cost benefit analysis as designed by the government. It is intended to assess the economic viability of project from the viewpoint of the society, and the procedure or the process are as follows. A. Define the objectives of the analysis in focus and examine the problem. 2. Consider the alternative causes of problems. Then number 3, enumerate the total cost, both social and financial, for each of the projects. Then 4, enumerate the total benefit in terms of revenue and social that will accrue from that particular course of action. Then number 5, evaluate all the benefits vis-a-vis the cost. Then from the evaluation, we determine the economic and social effect of a particular choice. And finally, we re-examine the problem and the chosen course of action to determine accomplishment. That is what is involved in cost benefit analysis. You have other details which you can read up in the cost material, the detailed cost material. We also have what we call cost effectiveness analysis. It is equally a technique of evaluation that involves using the least cost of producing a good or implementing a project, or the maximum output from a fixed amount. That is, using the least cost of producing a good or implementing a project, or the maximum output from a fixed amount. The analysis involves the review of the cost only. Again, that also follows some procedure, but then the emphasis is on cost and not on returns. Under cost-effective analysis, it involves number 1, defining the objective. Number 2, sourcing and assessment of alternatives. Number 3, selection or measures to be adopted. Number 4, development of cost estimates, then its collation using the agreed policy. Then number 5, creation of a model relating to cost effectiveness. And number 6, building of different expenditure models using cost estimates. We now come to some of the popular methods. We start with what we call the accounting rate of return. The accounting rate of return is measured in terms of a ratio. That is, we want to find the returns on an average capital or initial capital that is invested on a project. Well, there is a formula we use for calculating the accounting rate of return. It is defined as average annual accounting profits divided by average investments. We have two variables here: average annual accounting profits. If you take a year, for example, you have the profit for maybe for year 1, year 2, year 3, year 4, year 5. The addition of that will give us the total profits for the 5 years in question. But to get the average profit can simply be determined by getting the total profit and dividing it with the number of years. You have been given the profit for 10 years, year 1, so profit, year 2, so profit, year 3, so profit, up to year 10. And now you want to get average profit. It will be the profit of year 1 to 12, as the case may be, divided by the number of months, or years in question. So with that, we get the average annual accounting profit. Then it will not be expressed as a ratio of average investment. And when we say average investment, what do we mean? The average investment equals to the initial investment on the project, the residual value of the project added together and divided by 2. In other words, average investment is equal to initial investment from plus residual value all over 2. So by the time you get the average profit and the average investment, and you express the profit as a ratio of the investment, there is a return that will accrue to the organization in question, and that is what we call the accounting rate of return. Each time we see the word rate, we should appreciate that we are talking in terms of percentages. If you are calculating an accounting rate of return, if it is a rate of return, you cannot say that the answer is 10 million naira or 20 million naira. No, the answer should be in percentage. Also, we are relating one variable to another, as the case may be. As to the computation of this, really, in determining the accounting profit, we should know that we are referring to the profit derived from sales after removing all expenses. Accounting profit, the cash flow minus depreciation. So there are sometimes we may need to calculate the depreciation when we are given the cash flow in order to be able to determine the average annual accounting profit. And what is the decision criteria for selecting projects under accounting rate of return? The decision criteria is to accept the project that offers the highest percentage rate of return. Maybe you have 3 projects, project A, B, C. Project A is given an annual rate of return of 20%. Project B is given 35% rate of return. And project C is given 10% rate of return. What should not guide us as to which project to select? You select in the project that offers the highest percentage rate of return. So that is as simple, very, very simple. So the advantages and the disadvantages, you can please read them up on your own. They are just written in simple sentences. For example, the merits of the year is documented here as the fact that it is simple to understand and calculate. It facilitates expenditure follow-up. The profit of the project are considered throughout the useful life of the asset. And what about the demerits? Well, risk and uncertainty are not adequately catered for under this method. Also, the time value of money is equally ignored. So with that, like if you look at our examples in Iwuyi Local Government Council, where we are giving some data in terms of profit from year 1 to year 4, we are giving information on initial investment for each of the 3 projects. We are also giving residual value for each of the projects, and of course with that one we can determine the projects, the accounting rate of return of the projects. So with that behind us, we can go to payback period. What do we mean by the payback period? The payback period is a method that focuses on the time taken for an investment to recoup the initial amount invested in the project. By way of explanation, let's assume in the public sector we want to invest in a project. The project will cost 10 million, and the investment or the machinery, as the case may be, has a useful life of, let's say, 5 years. And given all the other information required, the cash flow and all the other details, and also the residual value, if you are to offer those assets for resale eventually, what will be the scrap value or the residual value? Given this, we can always determine or calculate the payback period. Where we are talking, we have an uneven cash flow. In that case, we can simply calculate our payback period as the amount of investment divided by the useful life of the asset. If Well, that is about if we are talking of an uneven cash flow. But if it is an even cash flow, in other words, you are receiving a constant sum of returns over the years. To calculate the payback period under that system, under that scenario, we have to calculate what we call the amortization schedule. We have a number of columns under the schedule. You have the year, you have the cash flow, then we have the cumulative cash flow. So we now start netting off the inflows with the initial outlay as at the beginning of the project. And so if a project, for example, is 10 million, and it will take you are given the costs and you're also given the returns, and you have to calculate the payback period. What we are saying is that this 10 million that we have invested, how long will it take us to be able to recoup the 10 million back? If you put up a residential building for rent, for example, you ended up spending about 15 million in constructing the bungalow. The question I want to ask yourself, if I put 15 million naira down and the bungalow is erected, and the source of revenue, the return will be the rent you collect on it, how much rent will you need to receive from that facility to take care of the total amount you have invested? So that time period it takes to recoup the amount you have invested in the project is what we call the payback period. Aside from that, of course, it is a measure in terms of years. The initial investment can be recouped in 2 years, can be recouped in 3 years, can be recouped in 5 years, as the case may be. So the answer that will arrive at under the payback period should be in years and months, not in naira. Then we now go to number 2, the other one, net present value. Net present value is the difference between the amount invested on a project and the expected return on such projects discounted at a given rate. Hence, the net present value could be defined as the difference between the present value of inflows and the present value of outflows. In other words, you need to calculate the present value of the inflows, and you need to also calculate the present value of the outflow. Then you now find the difference. The difference is what will give you the net present value. And just like the name connotes, the answer must be in terms of value. And the higher net present value you have, that is, the higher the amount of net present value received, the better the better the project is. So if you have 2 projects and you calculate the net present value of the 2 projects, one is giving you 10 million, the other one is giving you 2.5 million. Which one will you prefer if it was a personal decision? Is it the project that will give you 10 million returns or the one that will give you 2.5 million return? So the higher the net present value, the better the project. And that is the decision rule for a simple project. So with that taken, we can also consider the advantages and disadvantages of that method before we go to the last method, which is referred to as the internal rate of return. The internal rate of return, again, don't forget we are talking about rates here, so the answer must be in percentage. The internal rate of return is that discount factor that will give you 0 NPV. There's a particular rate. If you apply it to discount the revenue or the returns and the investment, it will give you a net present value of 0. When you deduct the present value of the returns from the present value of the initial outlay, you get what we call the net present value. The higher the net present value, the better for the organization. So we can simply define the internal rate of return as a rate of return that gives a 0 NPV. In getting this particular rate of return, we adopt what we call a trial and error method. And you'll be interested in 2 rates of return. Pick a rate of return when you apply the formula that will give you a negative absolute figure. Then also get a rate of return that will give you a positive absolute figure. Once you're able to define and you're able to identify those two, you are on your way to solving the problem. And in solving the problem, there is this relationship that is normally used. We calculate the IRR, and the IRR is calculated as R2 plus P1 all over P1 plus P2 into bracket R1 minus R2. That is the simple mathematical formula for calculating the internal rate of return.